Hi, I'm Tim Chubb, Chief Investment Officer here at Girard. We hope you're having a great year so far. We closed the books on 2022, a year of payback with both stocks and bonds down following strong gains in 2020 and 2021. Monetary policy and tighter financial conditions were the primary drivers of returns last year, but these headwinds are unlikely to be as strong in 2023. The prospect of better returns has certainly improved, especially over the long term. Today, we turn to some of what we may see in the coming year and a longer-term outlook which continues to be dominated by elevated inflation, slowing economic growth, and the path of central bank policy. As risks play themselves out over the next year, we expect volatility and perhaps better returns than many have expected. In the meantime, we maintain a measured approach on equities, but are eager about the opportunities the bond market now presents us. With that, let's jump into it. The key to answering what kind of landing, soft or hard, the U.S. economy gets is found in the labor market conditions. The main issue for the Fed and the economy remains that the labor markets are still too tight for the economy's long-term health. The Fed focuses on consumer behavior to gauge their success in managing inflation, and when higher wage growth leads to higher consumption and then higher prices, the Fed is likely to keep raising interest rates. Unemployment remains near record lows, and it seems the pain has not yet been felt, and the shortage of workers is complicating the recovery. The bottom line, the longer the U.S. jobs market remains too hot for the economy's own good, the greater the likelihood that the Fed will believe a weaker labor market is necessary before the end of the tightening cycle. Our base case sees the U.S. economy continuing to slow with gradually cooling inflation, reflecting a sizable drag from tighter financial conditions in the first half of this year. The economic recovery has been like Teflon, despite central bank efforts, thanks to a mix of easy money, fiscal stimulus, healthy private sector balance sheets, and the remaining tailwinds from the post-COVID normalization. This should cushion the economy when it slows down. The recent better-than-expected inflation data has investors feeling encouraged that the Fed will soon switch to a wait-and-see mode, taking time to assess prices and the squeeze that higher rates put on the economy. A risk to this outlook would be more likely to be no recession at all, rather than a deep recession, and assumes monetary policy was successful in causing a slowdown in inflation. It may seem unthinkable after the last few years, and it's certainly not our base case, but it would be a fitting chapter in this unusual cycle. This would likely require the Fed to tighten again later this year. The question now is not so much about the direction of travel for inflation as it has been about the speed and the persistence. The delayed impact of last year's monster rate hikes by central banks on activity and business profits are likely to become more evident against the backdrop of sluggish global industrial cycle. This means the spotlight should continue shifting towards a deteriorating global growth outlook. Entering 2023, we expected the dollar to weaken as the Fed gets closer to pausing their rate hikes. The dollar has made an about face, which could be due to the market getting over-exuberant about Fed easing, but also more positive data across the globe, including better than expected data in Europe and the reopening in China after zero COVID restrictions were lifted. After a recent rescue package in the Chinese property sector and the abrupt loosening of zero COVID measures, we anticipate that Chinese economic growth will soon enter a trough. Although significant progress may not be seen until Q2 or later, the departure from zero COVID is now more apparent. Structural obstacles related to population growth are likely to be overlooked by investors in light of tailwinds like low relative valuations and a weaker dollar. Turning to Europe, a recession may already be underway. The outlook for Europe is more challenging than the United States, as inflation is likely to persist for longer and in turn affecting growth. European economic prospects have been threatened by gas constraints, rationing risks, and winter weather, which impacts consumer income. Fortunately, a slower pace of tightening from European Central Bank, peaking inflation in Europe, and the ability to cut Russian gas imports have helped keep the region from sliding further economically. Incoming economic data has also been more resilient than expected for Europe, where manufacturing has adjusted remarkably well to higher energy prices. This news and additional fiscal support measures, primarily focused on supporting households, are likely to significantly offset the contraction in real income. The equity market has responded favorably to recent signs of easing inflation pressures. After enduring a painful valuation decline last year, and today, with inflation coming under control, investors are primarily focused on the 2023 profit outlook. Estimates have recently come down and may have priced in a soft landing given the current 3-month trend for estimate revisions is the most negative since the 2008 and 2020 recessions. In 2023, we expect less pain but remain cautious and focused on the gain which needs to come entirely from earnings growth rather than valuation multiple expansion. After peaking at 21 times earnings, the PE multiple for the S&P 500 index has dropped by over 30% to 15 times earnings before rising in recent weeks to 17 times earnings. This multiple looks reasonable given the current rate environment. Still, with potential top-line growth in the low single digits, profit margins should come under pressure. Earnings typically fall in a recession, but could this time be different? As long as margins remain relatively protected and corporate pricing power does not deteriorate too much, elevated inflation can keep earnings resilient and even slightly positive even as sales begin to sag. With the Fed tightening cycle expected to end in May, investors will begin shifting their focus towards economic activity bottoming and growth in 2024. More than 20% of companies have pre-announced earnings for the fourth quarter, the highest share since the first quarter of the pandemic. We suspect that companies may try to lowball fourth quarter results and set a lower bar with guidance for the remainder of the year with the expectation of jumping over it. Because of their sell-off last year, current bond yields are attractive and offer better compensation for risk than equities. Credit spreads, especially of the investment-grade variety, are broadly consistent with a recession and deliver over 1.5% more yield than comparable treasuries. High-yield corporate bonds are not quite as attractive, but should not see the excessive default rates given in a wave of refinancing that extended maturities and lowered interest rate exposure. We remain convicted that the drop for both stocks and bonds that defined last year, the third time that both had negative returns since 1926, should normalize, allowing bonds to return to being the port in the storm and compensating investors along the way. A challenging outlook for corporate profitability and a weakening economy should cap the near-term potential for global stocks, particularly in the United States. Although the feared recession is arguably the most anticipated on record, it has yet to been fully priced into stocks. When we zoom out and look at regional differences, we see that international companies trade at a substantially lower valuation multiple than U.S. stocks relative to history. This reflects in part that corporate profit forecasts have adjusted enough for a tougher economic growth environment brought on by factors such as increased energy prices, heightened susceptibility to higher rates, and more difficult inflation picture, especially in Europe. Although we are still underweight international equities to start the year, we believe that there will be more opportunities moving forward with an attractive valuation backdrop, a falling U.S. dollar, and the reopening in China has legs to support global growth. We understand that looking forward to financial market returns is fraught with contradictions and confusions, and after years like 2022, patience and discipline are always keys to long-term financial success. Please reach out to our team of expert advisors to see how Girard can help you achieve your financial goals.